One of the anomalies that can manifest itself in asset markets is the existence of bubbles. And we've seen bubbles throughout history, whether we're talking about stock bubbles like we have here in this data, or tulip bubbles in the Netherlands, or housing bubbles like we had at the beginning of the Great Recession. And a bubble is basically a sustained and significant departure of the price of any asset, whether it's stocks or tulips or houses, from its fundamental value. And the biggest problem is that the fundamental value is not something that we can directly observe. So it's not clear, for example, if you're sitting in, January 2000, whether the Nasdaq should be priced at 3,000 or whether it should be priced at 1,500 or whether it should be priced at 5,000. But what we see in retrospect, of course, is the clear existence of a bubble where we went from 1,500 in 1998 up to, almost 5,000 in 2000, the year 2000, and then back to 1,500 by 2002. And so while a bubble is always clear in retrospect, it's not always clear while it's happening. And so what we're going to think about in this video is sort of how those asset market bubbles happen, what leads to the increase, and then what leads to the decrease, um, and what, if anything, we can do about it. So the interesting thing is that prices, as we said in the last video, convey information, right? And so if a price of something goes up, then that could be because it has become more valuable, right? That's what we would expect. So, if the price of a stock goes up, we would expect that's because the firm is becoming more profitable, and the price is reflecting that information. Um, and it's important if the markets are working and if the buyers and sellers are fully informed for traders to respond to those messages. But sometimes there can be a lot of noise in the price, meaning it goes up and down for very little reason, right? Just because of, oh, I needed to sell these, I needed to buy those. That can result in a change in the price. And if there's a lot of momentum trading, if people see that increase in the price as a signal that the price is going to keep increasing, that can lead to self-reinforcing cycles where, oh, the price went up, I better buy. Oh, the price went up, I better buy. Oh, the price went up, I better buy. And that leads to bubbles. And then, oh, we hit some peak, and then it starts to go down. And then again, if we have those self-reinforcing cycles, oop, the price went down, I better sell. Oop, the price went down, I better sell. The price went down, I better sell, until we get to the bottom again. Um, and so whether or not there's a bubble is going to depend a lot on whether or not there's ease of trading. Is it easy to buy and sell these things? The availability of borrowing can make it much easier to buy, and so that's important. And then what the resale value is. And so, one of the things, stock markets can crash overnight, as we've seen in the past, whereas the housing market took a long time to crash because housing is not something that's so easily sellable. But it's also one reason that economists didn't think that a sort of national housing bubble was possible until, in fact, it was. So if we think about modeling bubbles, then we have to think about, what happens when there is some piece of good news, right? And the best way we can think about it is just by saying that there's some shift in the demand curve. And so if there's good news about profitability, then people say, oh, I want to buy that firm, that's the shares of that firm. The demand curve shifts to the right, the price increases. So say we go from 50 to 60. And then if that is interpreted as encouraging even more good news, then the demand curve shifts to the right again, and the price goes up from, say, 60 to 70. Oh, well, now the price has gone from 50 to 70. That's clearly a really valuable stock, and so I should buy it. That shifts the demand curve again, and we're up to 80, right? And so all it is we get this positive feedback loop that increases demand because of the higher price, which you wouldn't see, necessarily if you're buying, a pair of pants. Oh, the price is high. This must be a really great pair of pants. I'm going to buy it even more. Um, so if we sort of model that, it all depends on the role that beliefs play, right? If the beliefs dampen the price rises, right? If people say, oh, that price has gone up, that means it's higher than its fundamental value, then those beliefs will tend to dampen it and the price will go back to its initial value and stabilize. That's what's going on here in the blue. In the orange, the price is rising. Others believe the price will, signals a further price rise. Demand goes up even further, and we get caught in this positive feedback loop, which can amplify prices instead of dampening them, right? It means it goes up and up and up rather than coming back down to the fundamental value. And one of the reasons for that is, that fundamental value is really hard to know what it is, right? If every stock came with a fundamental value on it, then we would never expect it to go above that price. And so then the question is, this is really, the next two slides are really just saying the same thing as the blue circles and the orange circles in the previous slide, is that an equilibrium is stable if when you get an increase in price, people say, oh, that price is too high, and then brings us back to the original, right? So whether we want to think about that in terms of supply and demand, where the price goes up and then we say, oh no, that price is way too high, and we bring it back down, or whether there's a price dynamics curve, which in this case is flatter than 45 degrees. So when we get an increase in the price from P0 to P1, people say, ooh, that price is too high, and then we eventually walk it back down to a stable equilibrium, as opposed to an unstable equilibrium where more demand, an increase in demand leads to more demand, and we end up with an unstable price dynamics curve with a steeper than 45-degree line, so that we get that initial increase, and so we get a bigger increase and a bigger increase, and eventually we are in bubble territory. And then the question is, all right, well, what happens when the bubble pops? Well, that self-reinforcing bubble, it eventually has to be the result of an unstable equilibrium, right? Because eventually people are going to realize that the price is not going to go any higher, and it will crash eventually. And so then the question is, all right, well, how do we model those crashes? Well, something has to change, right? It has to change the expectation of continuously rising prices. In the housing bubble in 2000, sort of from 2000 to 2006, we ended up where, the prices were telling builders to build, 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 build because the prices were so high. And then we ended up with a whole lot of unsold houses, right? Empty houses. And that eventually brought the prices down. People said, oh, the prices are going down. And then we had that positive reinforcement, except now it was negative reinforcement, and we got the crash. Another way that the market can bring things back into equilibrium is through short selling. And there's the difference between short selling and long selling. If you buy an asset and you plan to hold on to it, that's you're long that asset, right? A short sale means you expect the price to go down. And so you basically borrow an asset, sell it to somebody else, and then you're going to have to buy it in the future in order to give it back to the person you borrowed it from. And so the idea is if you sell it now at a price of say 100, and then in 6 months you can buy it for 80 and then give it back to the person, then you've made a profit. And in the stock market, short selling tends to often keep bubbles in check, although not always. It's risky because you have to time the bubble correctly. And in some markets, short selling isn't really possible, right? It was really difficult to figure out a way to short the housing market, even for people who thought that there was an asset bubble. And that's basically what the movie The Big Short is all about. They eventually did find a way to short the housing market, and they made a heck of a lot of money, but it wasn't an easy thing to do.